Hey YouTube, welcome back to My Financial Focus. In this video, I want to talk about the short iron condor strategy, which is an options trading strategy that we can use to profit when the share price of the underlying asset trades sideways. I'm going to be using SPY for this example, which is the S&P 500 ETF. So let's get right into it. To sum up basically what an iron condor is, it's essentially just a call credit spread combined with a put credit spread. So in order to open this up in Robinhood, it's really simple. All we have to do is go long on one call. So in this example, we'll go long on the 454 call. And then we just want to go short on a call option with a strike price that is less than the strike price of the call option we went long on. The reason why we do this is because a short iron condor strategy is a credit strategy, and so we're receiving a credit for opening it. As you can see right here with the call credit spread, by opening up this spread we receive the $41 credit, and that's because that's the difference between the option premiums of the call option that I went short on. So I received $105 for the call option I went short on, minus the option premium of the call option I went long on. So I paid $64 for the long call, and 105 minus 64 is 41. The second thing we want to do is we want to do the same exact thing for our put. So we're going to open up a put credit spread, and all we have to do is short one put. So we're going to short the 449 strike price put, and we're going to go long on a put contract with a strike price that is less than the strike price of the put contract that we shorted. So in this case, I'm going to use a 448 strike put as an example, and I'm going to buy that put contract. And then you can see right here that opens up the short iron condor. And by opening up this put credit spread, I received a credit of $11. And I can tell that it's $11 because the short put that I opened, I received $50 for that. It says 50 cents, but remember, when we're dealing with options, we're dealing with 100 shares, so we have to multiply these values by 100. And so this is 50 cents times 100, which is $50. And then the put contract that I went long on is worth 39 cents or $39. And so $50 minus $39 is $11. And $11 plus the credit that I received for the call credit spread, which was $41, is equal to $52. So the total credit that I receive for opening up the short iron condor is $52. That is our max profit potential, as you can see right here. And our max loss potential is $48. The way we can calculate our max loss potential is by taking our spread, one of our spreads, so either the call credit spread or the put credit spread. Specifically, when we're looking for our max loss, we want to look for whichever spread is wider. So in this case, we don't really have to focus on that too much because the width between the strike prices of our call credit spread and our put credit spread are equal. You can see right here the difference between 449 and 448 is 100, and the difference between 454 and 453 is 100. So we don't really have to worry about figuring out which spread has a wider spread. In this case, in order to calculate our max loss, we just take the strike price difference between one of our spreads, in this case the call credit spread, and we subtract the premium that we received from shorting one of our calls and then going long on the other call. So in this case, the difference between, or the total credit that we received for the short iron condor in this case would be 52 cents. And so we just subtract that from the difference between the strike prices, which is 100. 100 minus 52 is 48. And this might be a little bit confusing for people who might not understand why that's the max loss, so I'm going to explain it right now. The way that we profit with a short iron condor is if the share price of the underlying asset stays in between our short call and our short put. The way that we experience our loss with a short iron condor is if the share price of the underlying asset increases beyond our long call or decreases beyond our long put. Now, there is a way that we can experience a partial profit or partial loss. And the way that happens is if the share price ends up somewhere in between our short put and our long put, or somewhere in between our short call and our long call. So I'll use the put credit spread as the example for this. So let's say, to calculate our max loss, let's say, for example, the share price dropped to $448.99, right? So for each penny that our share price drops below the strike price of the short contract that we have, our max profit loses $1. So if the share price on expiration date is $448.99, our max profit will be $51. If it's $448.98, our max profit will be $50, and so on and so forth, until eventually, if the share price of the underlying asset on expiration date is, in this case, $448.48, that would be 52 cents below our short put contract's strike price. And since it's 52 cents below the strike price, that would mean that our max profit of $52 would be eliminated. And at that point, every penny that it dropped below that, we would start to experience our max loss. And so eventually, once the share price gets completely underneath the strike price of our long put, we would experience our max loss for the entire spread of $100, because that's the difference between, or not $100, but we would experience the max loss of $48, because the max loss is calculated with the difference between the strike prices minus our max profit. And keep in mind, since this is a credit spread, like I said before, we're receiving the credit upon opening the spread. And so we get to keep that credit no matter what happens to the short iron condor. So even if the share price drops below the strike price of our long put here, or if it goes above the strike price of our long call, even if that happens, we still get to keep our $52 credit, even though the short iron condor will expire with our max loss of $48 per short iron condor. Now, just to recap here, just a quick little explanation of how we profit, because I don't think I went into that in as much detail as I should have. Like I said, when the share price stays in between the short call and the short put, we experience our max profit. And the reason why that is because, remember, like I said in the beginning of the video, a short iron condor is essentially a combination of a put credit spread and a call credit spread. And I made a video about this in the past, but I'll quickly explain it again right here. The way we profit with a put credit spread is if our share price is above our short put. And the way we profit with a call credit spread is if our share price is below our short call. And so, in order to profit with a short iron condor, in this case, since it's a combination of both strategies, the share price has to stay in between. It has to stay above our put credit spread and below our call credit spread, so it has to stay in between both of the spreads. And that's how the max profit works. That's basically how a basic beginner level explanation of this process would occur. And the last thing that I want to talk about, obviously, it's a second advantage that comes with the short iron condor. The first one being that we get to make money if the share price trades sideways, which is of course a massive advantage, because typically when we're dealing with options, we're betting on volatility, and so we have to see a massive increase or a massive decrease in the share price of the underlying asset in order to experience some profit. But obviously with a short iron condor, if it's trading sideways, we get to experience profit. The second advantage beyond that I want to talk about is the advantage of theta decay working on our side when we open up a short iron condor. The reason why this is because it's very similar to receiving a credit for selling a call, a covered call, or selling a cash secured put. Basically, as the short iron condor gets closer and closer to expiration, theta decay continues to eat away at the option premium. And in order for us to experience our max profit, we want the extrinsic value and the intrinsic value of these options contracts to expire worthless. And the way that happens is, remember, just to break it down to each individual leg of this short iron condor, since this is a put contract, the only way that it will have intrinsic value is if it's above the share price. If it's below the share price, it expires worthless without any intrinsic value or extrinsic value. Same thing with the call. In order for the call option to have any intrinsic value whatsoever, it has to expire beneath the share price of the underlying asset. If the call option expires above the share price, it expires worthless without any intrinsic value or extrinsic value. And we want that to happen as option sellers, or in this case, as by profiting through the short iron condor, because we receive the credit of 52 cents, and the only way that we get to keep that credit and not experience a loss is if the call options expire at $0 and if the put options expire with a premium of $0. And that happens as these contracts get closer and closer to the expiration date, because with theta decay, when this is basically quantifying the loss of the options premium for each day that we get closer to October 22nd. So with each passing day, this will drop by 34 cents. Since this is a put contract, theta, or really with any contract, with puts or calls, the theta value is going to be negative because it's eating away at the options premium. And if we go to the calls, we can see that with each passing day, these calls, they lose 37 cents from their premium. And every time that happens, that's money that normally, if we were going short on a call, we would gain. But since this is a short iron condor, our max profit potential and max loss potential is predetermined when we open it up, because we covered our short call with a long call and covered our short put with a long put. And so as the theta eats away at this options premium, it'll slowly get closer and closer to zero. And when it gets to zero and expires worthless, we get to keep our total credit of 52 cents. And we get our collateral back of 48 cents back to our account. And so we get to just walk away with the profit and not experience any loss whatsoever, as long as the share price trades sideways in between our short call and our short put. And that's basically it for the short iron condor. It's a very simple strategy. It has high profit potential, and it allows us to profit when the stock trades sideways, which is really cool. So if you found any value out of this video, be sure to leave a like and subscribe to the channel if you haven't already, and I'll see everybody in the next video.